Hello everyone. Gold has fascinated human beings since ancient times. It also glitters from the central bank vaults and jewelry bazaars world over as a precious metal. A lot has changed since UK was voted in favor of Brexit, and since then gold has been increasing day by day. Adding to it is the recent outbreak of the coronavirus pandemic that has pushed the commodity further higher. But long before the pandemic, the global community was blinking danger signs, and many countries were clamoring for acquiring as much gold as possible. For the past decade, many countries have been purchasing gold, and they were also shifting from various storage places to their own country, which has not been seen in recent modern times. Some analysts believe that the gold price will go up to almost $3,000 per ounce by the end of the year 2020 due to fear, speculation and uncertainty that is prevailing due to the current situation. But the real benefit, who is getting benefited from this situation, is the gold investors. Gold prices have soared nearly 15% in the last few months as compared to the decline to almost around 12% in the S&P 500. The predictions for sure are very bold. Let's see what it takes for this commodity to rise, why governments are purchasing so much of gold and how it affects their economy, and what are the catalysts that will drive this commodity and the prediction come true in today's Insights. The gold price has reached almost $1,700 in recent days, and this has created a lot of excitement on the potential investors who has seen the gold price rising from almost USD 1050 from December 2015. What needs to be seen is that whether this price will sustain or whether it will move forward. To analyze this, let us see the following charts. Okay, so this is the chart for gold prices for the last 100 years. It's a historical data for real inflation adjusted gold prices per ounce back to 1920. The current price of gold as of May is 1,732 per ounce. And if you see the last 100 years, it started almost at 400 US dollars per ounce, something around in 1920s, and then it came down to as low as $200 dollars per ounce in 1970, and then there was a 2 or 3 bull runs. So over the last 100 years, what we have seen is that the gold prices has only got 3 or 4 bull runs, and as of 2020 it is increasing slightly. It is going up, but it has not reached the 2011 or 2012 high of more than 1,900 US dollars per ounce. The reason, by the end of 2020 it will move forward could be due to the global instability, dysfunctional government policies, some sort of a shrinking supplies and a weak US dollar. Now, having seen this for the last 100 years, let us focus on the last 50 years, how the gold prices have moved, how it has traded in the market, to have a better understanding. Now, this is the chart which shows the gold price movement from 1975 to 2020 till today. Now, to make this study simpler, we can see it as per, in different periods. The first period, let us say from 1975 to 2005, this is the longest running period. In this period, the price went up and down, but always came back to a mean average of, say, around USD 400 per ounce. It was a period of long moderation with no extremes or volatility in prices. If you see that the only notable exception was in 1979-80, where it reached about US dollars 800 per ounce plus. This could be explained by a surge in crude oil prices and hence inflation over the same period, which was in the aftermath of the Iranian Revolution. Subsequently, both crude oil and gold eased back down. Now, what pushed gold to around USD 800 per ounce along with above is the political and economic convulsions and a rush of speculative investment at that time. The rally did peak, and then what was seen is 2 decades of weakness followed as central banks sold thousands of tons of gold. By year 1999, an ounce was costing around USD $250. Now, if we look at the period from 2005 to mid of 2011, it saw a substantial increase in the price, bearing a decrease over the second half of 2008 during the global financial crisis. This period spans the so-called 2005 to 2008 boom, when all the commodity prices increased. It was only the second boom since the 1950s. Now, the possible explanation which can be seen could be greater demand from emerging economies such as India, China, as well as a flow of investor money into commodity indices. China allowed more people to own gold and purchases soared. Exchange-traded funds, ETFs, which store gold on behalf of investors, also provided an easier way for people to hoard gold bars. Now, adding to this is that even Russia was scaling back purchases as they strive to bolster their economies. Between 2003 and 2011, annual gold demand rose from around 2,600 tons to more than 4,700 tons, according to the World Gold Council, which also pushed the prices up. Now, the 2008 financial crisis arrived in the middle of the gold's big rally, and early in that crisis, gold prices fell sharply as a broader plunge across assets forced investors to raise money by selling what they could. So what is seen is from 2003 to 2012, gold basically went up in every possible scenario, whether it was boom, bust, crisis or no crisis. Then for a few years, it just went down every year. So going forward, from a peak in 2011 until mid of 2017, gold fell again from US dollars 1,870 per ounce to US dollars 1,050, as low as in December 2015. Now, for some, this came as no surprise because the previous period's run-up was a bubble. From 2016, gold began tracking a mean level of around US dollars 1,200, where it eventually ended in September 2018. Gold has since been going up again and showing a longer upward trend since the beginning of 2020. In other words, it should not be attributed only to the COVID-19 pandemic. As of now, the price remains above the 2020 average of around US dollars 1,600, but still not above its all-time high of US dollars 1,900, which it touched somewhere in September 2011. So while it may keep rising, history shows that periods of decline are not unprecedented. Now, currently what we are seeing is a lot of gold's rise is actually the collected enthusiasm and optimism around it, and not necessarily because of its intrinsic fundamental drivers. Now, these gold prices are also rising because potential investors see the metal as a haven against global uncertainty, insurance against economic turmoil, and a hedge against inflation, especially with the Federal Reserve undertaking unprecedented levels of stimulus to combat the coronavirus pandemic. For now, gold costs around $1,700 an ounce, and some predict a bull run reminiscent of gold's price rally to record highs of up to around $3,000 per ounce by end of 2020. Even Bank of America Merrill Lynch has even said, it could touch 3,000 by end of this year or mid next year. But if history is any guide, it takes a sustained period of rising demand to really drive gold higher. And given the depth of the economic recession, economists expect because of the coronavirus, individual consumers may be buying less gold for some time to come. Having said that, some analysts predict that interest rates in some or most large countries will be at low or below zero for a very long period of time. This also brings to the conclusion that asset buying by central banks is tantamount to printing money and dilutes the value of the dollar, again adding to the appeal of gold. Now, some analysts predict that interest rates in most large countries will be at or below zero for a very long period of time. Also, some believe that this asset buying by central banks is tantamount to printing money and dilutes the value of the dollar, again adding to the appeal of gold. As such, it is predicted that the gold price will go up in the coming months. Now, having seen the last 50 years, gold price movements and the trend, now let us see the top 20 countries which hold gold reserves and its buying pattern from 1971 to 2019 to see how governments and central banks are keeping gold reserves. Let us look at this chart now. If you see, beginning in 2010, central banks around the world turned from being net sellers of gold to net buyers of gold. In 2018, if you see, official sector activity rose 46% to 651 tons of purchases, the highest level of demand, according to the World Gold Council. Now, the top 10 central banks with the largest gold reserves have remained mostly unchanged for the last few years. The United States holds the number one spot with over 8,000 tons of gold in its vaults, nearly as much as the next three countries combined. For 7 consecutive years, the Russian central bank has been the largest purchaser of gold, increasing its holdings by 274 tons in 2018. Kazakhstan was the second largest buyer and holds spot number 15 in this chart of the world's largest central bank gold holdings. Now, not every central bank is a net buyer. Now, Venezuela has been selling off its gold reserves in order to support its struggling government. However, gross official sector sales declined by 26% last year to the lowest since 2013, indicating that central banks are happy to keep their reserves in gold, historically viewed as a safe haven asset. Now, if you see, so far in 2020, demand has remained strong. Last year saw the highest levels of central bank purchases since 2010. Poland was a top buyer, with reserves growing 77% to 100 tons. As global debt continues to skyrocket, central banks and individual investors alike might want to keep gold in their pockets, as it historically has performed well during the times of economic downturn and geopolitical uncertainty. Now, if you see, it is also seen a large effort by central banks to repatriate their gold from other countries, mostly from storage in New York and London. Now, why are these central banks buying gold? It is basically to protect their currency's purchasing power in the event of an inflation. Therefore, it can build up its gold reserves without relying too much on external purchases that would have to be paid for in foreign exchange. Now, it also has significance in the economy of a country, meaning it determines the import and exports of the country and also the value of its own currency. Now, recently, some of the justifications given by the central banks for recent gold purchases are: Turkey says de-dollarization, India says forex diversification, Hungary says it's an asset that is nobody else's liability. Because currencies are unstable, markets are unstable. If you look at countries today, the USA is the largest holder of gold, followed by Germany, France, Russia, and the IMF have huge gold holdings. In the days to come, we can see all these countries, including India, increasing their gold holdings. Now, why is it happening? The dash to gold is all about geopolitics and geoeconomics. Gold serves as a mark of nationalist identity. To quote the governor of the National Bank of Poland, Mr. Adam Galpinski, he says, "Gold symbolizes the strength of the country." Stocking up gold has made sense to many countries during this populist climate. It is also a sign of many countries going away from dollars. Now the likes of, say, Russia, China, and many West European countries, they want to break the dominance of US dollars, having seen it being used as a leverage against all economic sanctions and trade threats. Now, what is it that it is driving the gold prices up? Whether gold will continue to go up depends upon many factors. The first thing is decision of the central banks on lowering of the interest rates. This goes simultaneously. When the interest rates are lower, the inflation goes up. When the interest rates are lower, there is a reduction in the cost of borrowings, and hence there is increased consumption, increased demand. And when this happens, automatically the gold prices goes up because governments want to preserve their reserves. The same thing happens when the price goes up, there is inflation, and when inflation happens, again the demand goes up and the prices goes up. So it works inversely. Lower interest rates and higher inflation drives the gold prices up. Secondly, it also holds true with exchange rates. When the US dollar becomes weak, it will cause the gold prices to go up. Gold banning is becoming more difficult in recent times, and this is also one reason that the gold prices are going up. The third reason is when times like this, crisis like this, more and more banks would like to procure more gold and keep it in their reserves. That is one of the reasons, as we have seen in the recent past, that how countries are accumulating gold. What happens is, when there is a huge demand, the price automatically goes up. Having said that, countries also believe that gold is more stable than a US dollar or a euro, which is not stable. So to protect the interests of the economy, central banks purchase more gold, thereby driving the prices to go up. Some analysts feel that the gold is trading at a discount. If the gold is trading at a discount, it is bound to go up with some premium going forward. That is also one reason that the prices are going up. Subsequently, we can also see that there is a fear, speculation, and uncertainty in the economic situation, which also forces people to buy more gold. Observing the current trend, it is seen that the yellow metal is performing much better than mutual funds, stocks, futures, or options as of now. Another reason is the constant change and the mixed signals in the trade talks between US and China has seen gold prices go up as per some experts. The yellow metal is considered as a financial instrument which does not erode its value over time, more so in these periods of economic turbulence. There could be more small factors which could make this prediction come true. Now let us look at these videos which supports the view that the gold prices will go up.
Abigail, the Fed's decision is really the key driver of markets today.
Oh, you're absolutely right about that, Romaine. We do have a risk asset rally on our hands. If we take a look at the influence on the futures market, we're going to see that it's all about the weak dollar. That, of course, and the Fed's surprising dovishness, or at least the way the markets are taking it right now. Take a look at the S&P 500 E-minis, up 0.6% off the highs, but nonetheless up for a fourth day in a row. Crude oil up 5.4%, surging. Another risk asset, less liquid. This tells you investors are really leaning toward risk, the best day of the year. And gold futures up 3.3%, the best day since June 26th of 2016, or 24th of 2016, I should say, when we had that big Brexit sell-off. Investors seeking a haven then. Right now, they are seeking potentially a hedge against inflation if the Dove or the Fed does go even more dovish than expected. Now, all of this, of course, you can see weighing on that dollar, and we are potentially seeing an interesting shift for this chart. Now, right now, support is holding. We do have some surprising strength. It's a 2-year chart of the dollar index. We see an uptrend. The dollar index holding that 200-day moving average over the last year. This range of volatility right now testing down onto that 200-day moving average, breaking out of a range. It's holding on, but it does appear to be on the cusp of a breakdown. If it does break down, you could see it go anywhere to 94, 92, maybe even 90. That would potentially drive gold and the other commodities and risk assets higher. To talk more about this, I'd like to bring in John Roque of Wolfe Research. So great to have you here,
Thanks,
John.
Abigail.
And what do you think of that dollar chart? Do you think that the dollar can hold in, or do you think we're going to see a breakdown?
We think the dollar is going to weaken. So
Okay.
we monitor about 30 currency pairs, and 26 of 30 are weakening. So the dollar is weakening sort of across the board. So we're just going to break.
So one great way to play that, of course, would be gold futures. And you have a
No
chart,
doubt.
and I just want to give you a little bit of applause here because you sent this chart to me yesterday before that breakout.
Even a blind squirrel finds a nut once in a while. So we like the breakout here, and we realize it's run a lot, and on a near-term basis, it probably is overbought, but we would use any pullback to the breakout level to buy. And we think on the futures, the August contract at 1451 is a pretty decent target.
Okay, so that's where you'd be looking to go long on those August gold futures. And then now let's take another look at a long-term chart of gold spot, and that really is an impressive range to possibly produce a huge breakout.
Yeah, so we actually like this one a lot better. We think it tells the bigger story.
Okay.
So just to give you an idea, so this has gone sideways for 6 years from the spring of 2013, and it's right up into the top of the range, which is roughly 1,400. We think it breaks out. We think this is a big base. And we think upon the breakout, gold's going to have enough gas in the tank, sorry for the mixed metaphor, to make a new all-time high. So we really are very positive on the setup here for gold, where big bases are sort of our raison d'etre, and this one has really set up to do something very powerful.
Okay, so you think that gold is going to make a new nominal high, and I know that technicians typically don't talk about the what, but let's bring that in just a little bit. Does this suggest, because that huge move higher out of the financial crisis, of course, that was driven by the Fed's accommodative policy, do you think that this base breaking out to the upside is a sign of it, or do you think it's more similar to what we saw at the end of the 90s?
I'm going to beg off your question only because I think the narrative will follow, right?
Okay.
Price moves first, as Paul Tudor Jones told us
Good
so many years
answer
ago.
from a technician.
Thanks. Price moves first, and then the narrative follows. It could be that all interest rates are going to be either nearer to zero or negative, as we're seeing in for many central banks, or it could be a weakening dollar. It's immaterial to me why it gets there, but the setup is very important, and we've done some long-term work for this relative to the DXY, which is the dollar spot index, and as that weakens, it's a very important input for this to work higher.
Now the question would be, should you buy gold? Now it is seen that investors who had gold in the portfolio along with stock, bonds and cash were benefited from 1989 to 2009. Forecasting asset prices is never easy, but investors need to be cautious always, to the extent that there is more uncertainty going to come because of the current economic situation and the COVID pandemic, and how the interest rates are going to move, which will determine the further movement in gold prices. If there are more negative news for the economy, then definitely the price of gold is going to go up. Having said that, it does not look so straightforward like that. If there is any bad news in the market, and if the stock prices goes down, then there are chances that people will sell off their gold to finance their other assets, which will or may bring the gold prices down. Equally, the situation may change if the current situation gets changed all of a sudden. For example, if there is a vaccine invented for COVID-19 and the US dollar strengthens in the near future, then definitely it will push the gold prices down. So the investors can also see and consider the 2011-2018 decline in gold prices, when following a bullish period, is a good example to keep in mind. But still, looking at the current situation and the overall global outlook, the prices are going to go up. So, what are the key takeaways? Supply, demand, and investor behavior drives the gold prices. That is, one, gold is often used to hedge inflation because, unlike paper money, its supply does not change year on year. Thirdly, studies have shown that gold have positive price elasticity, meaning that the price increases when the demand increases. However, the investment in gold for the last 1,000 years has not yielded much, even though the demand has increased more than the supply. Since gold performs better at times of economic crisis, it is better to have it in one's portfolio, to diversify one's portfolio. The trend of gold prices looks bullish, and it is believed that the prices will go up in the next 1 or 2 years, considering the current situation, and therefore it is considered to be a good stable investment option for the entire world. Adding to this, we can also say that when the economies open up, the results of the financial results of the companies will come out, which will also push the gold prices higher. Also, gold ETFs have recorded excellent profits in the last quarter, one of the best in the recent history, and that also will push the gold prices up. Even globally, the trend looks bullish, and as such, the prices are going to go up in the next 2 or 3 years. Thank you. I hope you enjoyed watching this video as much as I did making it. If you have not subscribed to my video, I request you to kindly subscribe and join me in this journey of learning and sharing. I will be back with more insights soon. Till then, take care.